Hello, Chris Mercer here at chrismercer.net and mercercapital.com. We'll talk today about income statement adjustments. A couple of posts ago, I talked about the three key elements of any business value. That is the expected future cash flows attributable to the business, the growth of those cash flows, and the discount rate with which those cash flows are discounted to the present to achieve value today. Today I want to talk about the cash flow itself and what we have to do to get an appropriate cash flow to determine a business valuation. To do that, we'll talk about what I'll refer to as income statement adjustments. And there are two kinds of income statement adjustments: normalizing adjustments and then control adjustments. We'll talk about these, but first let's point out why it's so important. The cash flow that we talked about in the previous post pertains to a particular level of value. That is the marketable minority or the financial control level of value. So if we have a different cash flow, we have a different value. So if we want to get to the appropriate level of value for our base value, then we have to get the appropriate level of cash flow. Well, what is that? It's the as if publicly traded or the marketable minority value, which, as we talked earlier, and as we'll talk more in the future, is very synonymous with the financial control value. So we look at an income statement, and what kinds of things do we do? What are we looking for? Well, we're looking for normalizing adjustments. In other words, we're going to normalize the financial statements to a public equivalent basis. Does that mean that the company has to be public? No, of course not. But that's the ideal that we're looking for. Normalizing adjustments are for non-recurring or unusual items or for the expense or income of non-operating items. That's the first kind. The second kind is what I refer to as discretionary or agency expenses. In other words, the expenses of owners that are well in excess of what would be incurred in a well-run publicly traded company. So non-recurring and discretionary or agency expenses. Now, some appraisers will say that's a control adjustment because the minority shareholder can't control. Well, the minority shareholder over here can control because he can sell the stock and leave the company. So that is not really an argument for not making compensation-related adjustments in valuation. That's well spelled out in my book, the second edition of The Integrated Theory. Travis Arms and I have the third edition coming out hopefully later this year. The second kind of control adjustments are what I call control adjustments. And they're adjustments to relate the income statement to the financial control buyer or to the strategic control buyer. On the levels of value chart, the financial control adjustments might be those adjustments that a buyer would make and share in valuation with a seller. They're typically quite minimal because the marketable minority value and the financial control value are fairly synonymous. In other words, the control cash flow to the marketable minority and cash flow at financial control are generally speaking the same. What about the strategic control level? Well, we need cash flow strategic, and those adjustments are the kinds of synergistic or strategic adjustments that buyers of companies that have strategic or synergistic intent might make. And that would be, I'm going to reduce expenses substantially. I'm going to sell into a new market, things of that nature. And those strategic or control adjustments create a strategic control premium, but the cause of the strategic control premium is not something magical. It's the cash flow adjustment. Now, there's a publication out called The Measurement and Application of Market Participant Acquisition Premiums, published by the Appraisal Foundation. The working group there equated the what's called a market participant acquisition premium or the strategic control premium as the result of those cash flows that are the result of these control adjustments. So you see, if we want to value a company, if you want to understand the value of your company, you have to make appropriate normalizing, or if your objective is control adjustments. I hope this is helpful. A good day.